We've got a strong year ahead, which is very typical of election years. And also it'll spread to the other asset classes that have been left behind. So it should be exciting and rewarding for most of us. Crypto is the horse I back the most. The fastest horse in the race, best risk-adjusted returns, high correlations to this global liquidity index, which is our everything code. So we know how the asset price behaves, which gives us a competitive advantage when we use our proprietary frameworks. Bitcoin is just a macro asset. All of the noise you see from the Financial Times, all the newspapers, all of the media, to the noise on Twitter, to the naysayers, oh my God, this is magic internet money, this is magic beans, they're all wrong. They're all wrong. Bitcoin is a macro asset, like everything else, works from the same thing. Liquidity, business cycles, secular trend. Global M2, fabulous correlation, Bitcoin.
Don't forget to subscribe, crypto traders. Let's continue with the interview and the analysis of this one. In the dynamic landscape of investments, cryptocurrencies has garnering attention as a lucrative and promising asset class. Bitcoin stands out as the undisputed leader, offering compelling risk-adjusted returns. The allure of cryptocurrency as an investment vehicle lies in its unique characteristics and the transformative potential it holds. Bitcoin has captured the imagination of investors as a store of value and a hedge against traditional market uncertainties. Its decentralized nature and growing acceptance contribute to the perception of Bitcoin as a digital gold standard. One of the key factors propelling the prominence of cryptocurrency is its high correlation to global liquidity. As the financial world becomes increasingly interconnected, the movements of liquidity across borders have a profound impact on various asset classes, and cryptocurrency is no exception. The correlation to global liquidity positions cryptocurrency as a responsive and adaptable investment, capable of navigating the currents of the broader financial ecosystem. Investors are drawn to the potential for diversification that cryptocurrency offers, especially in a traditional investment portfolio. The digital nature of these assets allows for seamless integration into a modern investment strategy, presenting an opportunity for investors to broaden their horizons beyond traditional markets. Let's continue with the interview.
Why I choose crypto versus the NASDAQ? If the NASDAQ's such a damn good bet, versus Bitcoin divided by the NASDAQ year on year also follows M2. So when liquidity conditions are rising, crypto outperforms tech stocks. And that's because of the structure and incentive systems built into a tokenized ecosystem, where you're owning part of the underlying network and you get paid for the adoption of the network. Some equities can look like Bitcoin. We've seen Nvidia, for example, see network adoption at scale, and it ends up looking a lot like Bitcoin. But the index as a whole, it will always underperform. So that's why I'm so heavily weighted in the crypto space. The central banks are living in the past. What they look at is the current read on CPI and the current read on unemployment, not the forward-looking stuff. I'll show you the forward-looking stuff and you'll see how that's going to fold out into the headline, whether it's core CPI, headline CPI.
A notable trend has emerged where cryptocurrency is increasingly favored over traditional tech stocks, particularly those listed on NASDAQ. The outperformance of cryptocurrency in these scenarios can be attributed to the unique dynamics of tokenized ecosystems coupled with incentive systems. Unlike traditional stocks, cryptocurrencies often operate within decentralized networks where tokens represent ownership or participation. These ecosystems are designed with intrinsic incentive structures, encouraging active participation and engagement. The tokenized nature of these ecosystems adds a layer of versatility and responsiveness to market conditions, allowing them to capitalize on increased liquidity. As liquidity rises, the tokenized systems within the cryptocurrency space are better positioned to adapt. This adaptability contributes to the outperformance of cryptocurrency compared to tech stocks listed on traditional exchanges like NASDAQ.
And the unemployment numbers. A lot of inflation is actually driven by the really lagging components of shelter and wages. These things lag between a year and 2 years, which is why coming out of a business cycle trough, disinflation continues for 18 months or so before rebounding. That's why central banks tend to be easing well after recession has ended. because they are living in a lag time horizon. They always do. It's bizarre, but that's how it is. Beautiful chart here. Fed net liquidity and Ethereum. Bitcoin has actually outperformed Fed net liquidity. The beach ball underwater. Why? Because of the narrative around the ETF. Also, in macro crypto spring, Bitcoin always outperforms. Much like in macro spring, treasuries tend to outperform credit. Later, when we move to macro summer, alts, ETH first, Solana, others will start to massively outperform Bitcoin, much like junk bonds outperform treasuries. So ETH is just doing what it's supposed to be doing, but it's not giving us the big surprise. I think that surprise comes the moment the ETF is out in Bitcoin, and people will focus on the ETH ETF, and it'll bring the ETH ecosystem alive. This year, it's been a story of Solana, which I've been along all year, and Bitcoin. That barbell has been the best trade in the world. Well, in fact, just owning Solana has been the best trade in the world, bar none. But ETH, it'll play catch up. It'll do well. PPI, G5 PPI, producer prices. This is the pointy end of the stick, the thing that moved quickly. This is the producers' prices, and they tend to adjust very fast. It has a 2-month lead on CPI and suggests that G5 CPI could head down to 0 pretty soon, sometime in 2024. And that's something I've talked about a lot. I think inflation evaporates in 2024. The Eurozone PPI has been shockingly weak, down below negative 10%. And it tells us that Europe's CPI is going to come down to 0 or below in 2024 and early-ish in 2024. So that should bring the ECB into action, cutting, because they care about inflation more than anything else. It's their single mandate. If we look at core PCE and just look at the 6-month annualized change, this is here in the US. Well, here in the US, I'm in the Cayman Islands, but you know what I mean. That's already at 2.5% and falling. So it's showing that the inflation pulse is well behind us and stimulus becomes more likely. Even just using the base effects of core CPI year on year, we get to negative by the end of 2024. Do we get there or not? I don't know, but I think we're going to get very low and lower than the market expects, and that would be a surprise. It'll be a surprise on the upside of risk assets because it will mean more stimulus. And I think that's a really important thing. It also takes away the headwind from the economy. Now, obviously, we know with CPI, it's a bit of a con because those prices never come down. Even if we get a little bit of deflation of 1%, it doesn't make it easier for people. But hopefully, the offsetting rise in your portfolios will help somewhat. The other way of looking at PPI is taking out that really lagging shelter component, which that's not going to deflate for another year. It'll keep deflating for a year or so. But if we take that out, core inflation is already at 2%. Now, I know you can say, well, why do I care about, inflation that doesn't include my house? The point being is it's showing the trend. I'm not saying inflation's any less or you don't feel less pain. What I'm saying is all the other elements of inflation are coming down fast. And a lot of people tell me, well, inflation's sticky. And most people don't come up with any facts as to why that is. It's a hunch. They want it to be sticky. They want to relive the Volcker glory days. They don't want technology stocks to rise because they want to see the world that they know succeed, which is kind of crazy. You have to just look at the data and not bring your own biases to it. I mean, there is a probability, I'm not discounting it, that something changes in the inflation structure. But with this aging population, I think it's difficult. I do think unemployment will stay higher than expected over this cycle, but that's a function of less people in the workforce. And that's offset by the baby boomers who don't spend as much. Anyway, this CPI cycle is no different than all of the others. It's basically identical. It's this Mount Fuji pattern, up, down, and we should continue lower. Even that bounce is due to the year-on-year effects that we've seen recently, and we should continue over time to see CPI keep falling below the Fed's target.
Forecasts suggest that deflationary pressures are poised to persist for another year. signaling a continued period of economic contraction. However, it's noteworthy that coin inflation has already reached a rate of 2%. While coin inflation is on the rise, other elements contributing to overall inflation are experiencing a rapid decline. This divergence in inflationary pressures underscores the complexity of economic dynamics, where certain factors may be moving in opposite directions simultaneously. It is crucial to challenge the prevailing belief in sticky inflation, as empirical evidence suggests otherwise. The notion that inflation tends to be persistent or resistant to change lacks substantial factual backing. In reality, various elements contributing to inflation are demonstrating a notable decrease, challenging traditional assumptions about the stability of inflationary trends. As we navigate this landscape of contrasting inflation and deflationary forces, it becomes imperative for policymakers, economists, and investors to adopt a nuanced understanding. Recognizing the multifaceted nature of inflationary dynamics along with the divergence in trends among different contributing factors is essential for informed decision-making.